Welcome to Markets Now. I'm Michelle Rourke with Mike Zuzulo of Global Commodity Analytics. And we see quite a bit of green on the board here this morning in the grain and livestock futures. And Mike, let's start off talking about corn and soybeans. Took a little break yesterday as we ran up into chart resistance. We're still watching South American weather. Is there enough concern there to get us over these resistance areas on corn and beans?
Yeah, thanks for having me back, Michelle. I think that we're going to find that out potentially on Wednesday here I think it's an important swing day because the models in South America, Argentina specifically, are really kind of firming up with 100-degree heat right now, but some pretty decent rainfall potential in key areas of the Pampas region, Santa Fe region especially, being watched by the trade. I think, we're looking at maybe an inch of rain on Saturday. And so I think in the aftermath of the January crop report, where we tightened those supplies here domestically, and the trade, I think, took more seriously what was happening in South America, we're going to find out whether that weather market is the dominant force leading this market higher or not. In other words, do we test support levels if the noontime models come out and get wetter or consistently bring out some rainfall potential? We've got that, I think, as the major theme of this week so far, but those outside markets are also very, very important as we see the currency markets making some big moves as well.
Yeah, and I want to talk about that in a minute, but what areas of resistance do we need to get over here? What are you watching?
Yeah, I think we're right there when it comes to lead month corn and lead month beans. So the overnight highs, that 480 level, that 1080 level in beans, those are numbers that I think are really important. I should say 465 level in corn, 1080 level in beans. The overnight lows, though, I think are even more important because if you look at the overnight March low, you're talking about 474. And so 1080, 480 area, 474 was the low in the overnight. Recall that 473.25 level in March futures was the 2024 high that we were able to get above at the beginning of this week. If we slip below that, I think that could bring in some negative sentiment, especially if it does come together with some wet weather.
Yeah, and 1080 on beans is kind of where that 200-day moving average is.
That's right. And, those are the same levels roughly where the 52-week moving averages are as well in the soybeans. So the big thing about Argentina, I think it's important to realize, for me anyway, in the analysis is if you talk Argentina, you're talking about meal and you're talking about corn in terms of price leadership to the upside when it comes to weather. We still, after the January futures went off the board Tuesday, we still have that meal market kind of lagging, but it's coming around. So that's going to be an important feature. $300 meal, in other words, in the now lead month March is a key level too.
Yeah. But there's talk that Brazil will make up for what Argentina doesn't produce on the soybean side. Like you said, it's important because meal is the driver there. Let's talk a little bit about this currency situation here, because you are closely watching the dollar because we're at kind of a pivotal area here, aren't we?
Yeah, we really are. I think you can make a pretty good argument that the dollar, ever since we've had a lot of news hit the news wires since the holiday, that the dollar's been trading a lot of the tariff news. And what we've seen is a pretty concerted effort to take premium out of the dollar, let some air out of the balloon. And I think that goes hand in glove with a rotation back into commodities on inflation. I think that's where the dollar is kind of primed for a sell signal against the Brazilian currency, the Chinese currency, the Russian currency, and the Mexican currency, and the Canadian currency. So pretty interesting potential unwinding, and that's why I think Wednesday could be a really important swing move day one way or the other, because we're going to, I think, find out maybe whether the weather's more important or whether the outside markets and the currencies are more important. So in other words, if the beans continue higher after Wednesday, but we have rain coming in Argentina, I'm going to look to see if that Brazilian real has not made a major low and broken through a resistance line against that dollar on the monthly chart.
Yeah, because it has been making new lows to the US dollar. So that's been a headwind for us for sure. Okay, so part of what's influencing the dollar, let's talk about the tariff situation. Certainly, we're hearing more about incremental tariffs. And do you think the president will go through with that? And what would that look like?
I do. I think Canada and Mexico have both made moves in terms of olive branches to negotiate in earnest and with a fair look at what President Trump is wanting in his new administration. Just on Tuesday, the Mexican government is looking to sign a mandate, a decree on the 17th of January to shift Chinese imports of around 10% and move those to nearshoring. In other words, make them North American imports and intra-country trade. And I think that was a big step in the right direction. Ever since the Prime Minister of Canada has resigned and leaves in March, many Canadian ministers are talking about moving in the right direction with President Trump. One of the main ministers just coming back from Mar-a-Lago in Florida this past weekend, suggesting that he was very serious about the tariffs and that they needed to work with him, is how I read it. So I'm more optimistic, and I think that's why the currency market plays out so much in my mind.
No doubt. And of course, we're watching that because of the impact it could have on inflation. So incremental tariffs on a monthly basis would be less inflationary, would it not?
It would, and I think it would stimulate more of a design and more of a rotation back into commodities by the large investors, which this is where the inflation side of the equation oftentimes gets overlooked because of the tariffs and the idea that we'll go into a global recession and commodity demand will be weak. But the inflation numbers suggest opposite that. So we're trying to put those two pieces of the puzzle together.
And speaking of inflation, we had CPI out this morning. The core CPI was up, I think, 0.2%. And so for the year, the annualized rate, 3.2%. Now, the 0.2 is actually a little bit more than expected. But how do you read these numbers?
It's not coming down. And I think that's how the investment community is looking at it, Michelle. And that's why I think in part why copper is at a 1-month high and crude oil is at a 6-month high. It's not necessarily because China is improving. They've had some good economic data, but overall, I think they're still very deflationary. So I really do think it goes back to this stubborn inflationary pressure. And I think this is where the wheat comes into play. We've got the copper running. We've got the crude oil running. If the dollar makes a top against these major currencies, especially the ruble, why wouldn't the wheat finally find some short covering and get a buy signal in its monthly chart? It's got a very nice wedge pennant formation in the monthly soft red wheat chart. That soft red wheat minus the corn is down to 60, 70 cents premium. So it's starting to eat into the feed grain side of the equation against the corn. So that's the missing link right now, and it has been for quite some time.
Okay, yeah, and wheat has been on, it seems like the short side of just about every spread, Mike. And I think what Chicago wheat hit new contract lows just a couple of days ago. It's just been so pressured, but you think it's just tied solely to this dollar?
I think that's the majority of it, because the rising tide should lift all boats if we're really going to see rotation into the ag commodities in earnest. And that's the one thing that's been missing, is the strong yields in the bond market keeping the dollar high.
That makes sense. All right. What about the cattle market? Seeing a little rebound today after a couple of days of what I would call a healthy correction, but it looks like higher cash trade is winning out again, huh?
Yeah, I really like the cattle market. It's not a complex market right now because the cash is driving. You know, we've got 205 plus in the negotiated cash market, Michelle, against a 198 futures market. So we've got a nice premium there that I think the funds can keep their net long positions in place, if not even get longer. And I think also the USDA report last week did a lot of good in answering my question as to whether how much is HPAI and the bird flu impacting positively the price of the red meat because of tightening protein supplies. And we saw it in eggs, we saw it in turkeys, noteworthy in the dairy as well. So we've got a real issue with protein in terms of competing with high-priced beef and high-priced pork. USDA made note of. So it's a very clean market. I think you trust the cash market. You trust the winter weather potentially hurting the marketing's availability or dragging down weights, especially if we turn cold and we get another big snow, which some of the weather models, in my opinion, are starting to suggest that as we get closer to month end.
Yeah, it's hard to tell how much weather premium we actually have in the cattle market just because this record cash has continued to push it. We should mention feeder cattle making all-time highs here, at least on the front month. And are you concerned that the funds are record long there, and when we start opening the border to Mexican feeders, that thing could roll over?
I really am between that and another leg higher in the corn if Argentina stays dry. And I think you bring up a huge point about the managed money net long positions. We're not at a record yet in fat cattle. That was back in 2019, around 154,500 net long futures and options. We're still about 10, 15 below that as of the last Commitment to Traders report. Feeders, though, have several things going against them. I'm also hearing from my cow-calf ranchers that they're pretty much done with their strings at this point for the next 30, 45 days. So not sure we're going to get a lot of cash support out of the feeders like we have been in the fat cattle market.
All right, thanks for joining us, Mike Zuzulo with Global Commodity Analytics. That's Markets Now.